So the point is, there are only a very small handful of companies that can actually raise their prices ahead of the rate of inflation. Good morning. This is Dylan Jovine from Behind the Markets. Happy Monday. Wow, we are at the 28th and the month ends on Thursday, the 31st, Halloween. Very exciting. I'm very excited. So today I wanted to talk about inflation, how to protect yourself against inflation, because as we talked about last week in the Paul Tudor Jones interview, he goes on and says, basically, no matter how you slice it, all roads lead to inflation with this kind of spending that we have. And frankly, have you ever known a new president, whoever wins, to come into office and not spend money? I haven't. So we all know that spending seems very likely to continue. So all roads do lead to inflation, and inflation means that the depreciation of our currency. So one of the most common questions that I've gotten in the past week is, how do we protect ourselves from inflation? Should I buy gold? Should I buy commodities? What should I do to protect myself against inflation? And I'm going to tell you something that not many people know. One of the best ways, my favorite way to protect myself against inflation, are the stocks of companies that actually have pricing power, that can raise prices above inflation. During an inflationary time, you want to avoid companies that don't have pricing power and that have big capital expenses. I'm going to break both of those down for you, take one at a time. Let's talk about pricing power. I'm going to take one of my favorite companies, Hershey. Hershey's is a company that actually has been able to raise its prices above the rate of inflation, meaning that if the price of goods that it uses to make chocolate, like cocoa, goes up 2%, so inflation hits them on their cost side, they've been able to raise the prices of a Hershey bar 3%, 4%, 5%, and consumers, people like me, customers like me, we keep buying them. So the point is, there are only a very small handful of companies that can actually raise their prices ahead of the rate of inflation. Out of 15,000 publicly traded companies out there, maybe 400 or 500 can actually have pricing power to raise their prices at a rate higher than inflation. So actually, companies like that actually grow above the inflation rate. During inflationary environments, they actually do well. So let's say that there's 500 companies like that. Now, we're going to have to chop off another 200 from that list. So A, we want companies that can raise their prices ahead of the inflation rate. B, we want to avoid companies that have large capital spending requirements. Think General Motors. Remember something, inflation means the cost of everything goes up. Also means the cost to replace big plants that manufacture cars go up also. So imagine you're General Motors and you have this massive plant you built in 2000. By the time 2025 comes around, you've got to build another one to build this new type of EV car. Now, the cost to build that plant would be substantially higher today than it was before. So that really eats into cash flow, especially for companies like GM that don't have pricing power. So the playbook for inflation, here it is. There are three things. Find companies that have pricing power. Find companies that have low capital spending, which will increase their return on investment. And of course, find companies that have little or no debt. Companies like that actually perform better than gold, than commodities, than any of these other alternative things over time. And the good news is companies that have pricing power are many of the Magnificent Seven tech stocks. You have to think of the S&P 500 as like a neighborhood, a very big neighborhood with 15,000 companies. There are only select little pockets in that neighborhood, select individual companies that actually have pricing power that can pass that down to their customers, where their customers will keep buying the product basically within, as long as the price is marched up reasonably in relation to inflation. Look, a Hershey bar costs what, $1.50 now? When I was growing up, there was 50 cents. Maybe it was even less. 50 cents. But now they're $1.50. That's inflation. And you know what? It wouldn't shock me if they were $2. So basically, if inflation goes up 2%, I'll pay an extra 5% for my Hershey bar. I don't need it a lot. I'm getting to the age where, my daughter and my son look at me like, really? Like, you really need another one of those? They don't realize that I do. My soul needs more Hershey. So anyway, I guess the big takeaway for today is you don't need to be a gold bug. You don't need to invest in Bitcoin or gold or any asset that doesn't produce cash flow. You can focus on companies that have pricing power, low capital expenses, which basically means the return on capital investment is high, and low debt. And you do terrific during times of inflation. As a matter of fact, these companies like this end up marching and being leaders and really taking off. So we're going to be looking for more of those. That's the kinds of companies that I buy anyway, because they have economic characteristics that do better in any market, but especially they shine during times of inflation. Have a good Monday.